We certainly do. It's early days. The UK hasn't yet Brexited, and we haven't yet felt the squeeze from inflation, which is moving upwards and is ahead, likely to squeeze real household income and spending power. But for now, the economy is surviving on any sentiment shock from the Brexit vote, and that is certainly good news. Consumers are still spending, confidence remains high, and certainly in terms of UK GDP growth for the rest of this year, things are looking pretty good.
And just to underline, when we talk about the services sector, we're talking about things like shopping, banks, hotels and that sort of thing, aren't we?
That's absolutely right. Yes, this is the lion's share of the UK economy. It's about 4/5 of UK GDP, so it is big. And as you say, it's things like the retail sector, the distribution sector, hotels, restaurants, banking, and it is the big bit of the UK economy. So this is the first big bit of official data that we've had in the month after the UK voted to leave the EU, and we had a survey which plummeted very sharply in the immediate aftermath of the Brexit vote, and it's very reassuring that the official data didn't follow that path. It has held up much better, and so we are breathing a sigh of relief after this morning's figures.
And just try and sort of relate this a bit more closely to people's lives. When the economy is growing like this and when people are spending more in the shops, it filters through to jobs, doesn't it?
It does. So one of the things we were looking for initially is whether people stop spending and that affects how much money businesses are bringing in. And in the end, if the businesses aren't prospering as much, that could lead to eventually higher unemployment if firms have to lay off workers. So certainly in terms of the short term, that's good news for the headline economy, and that's good news for employment and the UK labour market. But one point we economists are pressing is it is very much early days in the post-Brexit vote world, and the labour market tends to react to what's going on with the economy with a bit of a lag anyway. So it's good news. The labour market's holding up pretty well at the moment anyway, but certainly we need to just be a little bit cautious about what the next steps are, and the big thing we're looking at is the extent to which inflation, which is set to move up, actually squeezes spending, and the data turns down a bit over the months ahead.
And the Bank of England will be watching these figures as well, and it'll perhaps have some bearing on their next decision on interest rates.
Yeah, I certainly think it will. So they've outlined their view for what the UK economy might do in the immediate months after the Brexit vote, and I think today's figures are a bit stronger than what the Bank of England would have been looking for. So certainly if it's thinking about whether it might want to cut interest rates again, it already cut them back in August, whether it wants to make another cut at its November policy meeting, it might perhaps think twice about doing so and possibly wait and see whether consumers really do stop or ease up on their spending once inflation pushes up. So it might push the Bank of England into a bit more of a wait and see policy.
Okay, yeah, Victoria Clark there at Investec. Thanks very much. Just time for a quick look at the markets before we leave you. Global markets were sharply lower as investor sentiment was dented by renewed worries about the financial health of Deutsche Bank following reports that some hedge funds were moving their businesses out of Germany's biggest bank. Sentiment was shaky, which saw the Asian markets close lower overnight. That effect filtering through to Europe this morning. That's why they're all in the red. That's all the business.